Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Everest Medicines Limited annual report. Everest Medicines Limited is a biopharmaceutical company that specializes in the discovery, development, and commercialization of therapies and vaccines for critical unmet medical needs in Greater China and other Asia-Pacific markets. The company's pipeline includes several promising treatments across various therapeutic areas. One of its key products is Nefecon, an oral formulation of budesonide for the treatment of immunoglobulin nephropathy, IgAN. Everest Medicines also offers Xerava, a fully synthetic fluorocycline intravenous antibiotic for treating infections caused by susceptible gram-positive, gram-negative, and anaerobic pathogens. Additionally, the company is developing taniborbactam, a beta-lactamase inhibitor in Phase 3 clinical trial for serious bacterial infections. The company's pipeline also includes etrasimod, an oral selective sphingosine 1-phosphate, S1P receptor modulator, in Phase 3 clinical trial for moderate to severe active ulcerative colitis. Zetomipzomib, an immunoproteasome inhibitor in Phase 2 billion clinical trial, is being developed for a range of immune-mediated disorders, including lupus nephritis. Everest Medicines is also working on Evrone, a covalent reversible Bruton's tyrosine kinase, BTK, inhibitor in the Phase 1 billion clinical trial for renal diseases. Furthermore, the company has an mRNA platform therapeutic vaccine for cancer and autoimmune diseases, as well as EVE-ART-106, a polymyxin derivative designed to treat FMDR gram-negative bacterial infections with reduced toxicity and nephrotoxicity. Overall, Everest Medicines Limited is a biopharmaceutical company with a diverse pipeline of innovative treatments and vaccines addressing critical unmet medical needs in Greater China and other Asia-Pacific markets. Everest Medicines Limited market capitalization of $13 billion is materially smaller than most of its industry peers of roughly $23 billion. Everest Medicines Limited trades at a higher price-to-book ratio of 2.13 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 18% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for the company are multifaceted. One key driver is the expansion of sales teams and coverage in core hospitals, which has led to increased adoption of products such as XERAVA and NEFECON. The introduction of new diagnostic tools, such as the GDIG Aeon diagnostic tool, has also improved diagnostic rates and treatment cycles. The company's strategic agreements with Haisen Biopharmaceutical have provided access to critical care products from the Haisen portfolio, further driving revenue growth. Additionally, the commercial success of NEFECON as a foundational therapy in IgA nephropathy has led to substantial revenue growth from overseas markets. The launch of new products, such as VELSIPITY and LEROCHOL, has also contributed to revenue growth. Furthermore, the company's expansion into new therapeutic areas, including ophthalmology, cardiovascular, and critical care, is expected to drive future growth. In contrast, there are no explicitly mentioned drivers of revenue decline. However, it can be inferred that the NRDL, new drug registration, and listing process for NEFECON in Chinese mainland may have had a negative impact on revenue growth in certain periods. The analysis of net income and profit margins reveals mixed results. Initially, it appears that net income experienced a significant increase of plus 71.6%, as indicated by the shift from RMB-1,041.4 million to RMB-297.8 million on page 32. However, this trend is inconsistent with other pages, which provide no information on net income change. In terms of profit margins, there was an expected increase due to localized production, page 6. Conversely, the actual data shows a decrease in gross profit margin from 74.6% to 69.3% on both page 9 and page 32. This discrepancy suggests that the anticipated benefits of localized production did not materialize as planned. The company's financial performance indicates a healthy trend in its operating cash flows. According to the provided data, the company generated significant operating cash inflows of RMB 2,439,413. This is a substantial amount that reflects the company's ability to manage its operations efficiently and generate revenue. In contrast, the operating cash outflows were relatively lower at RMB 1,412,994. The difference between these two figures represents the net positive operating cash flow generated by the company. With an excess of RMB 1,026,419 in operating cash inflows over outflows, it is clear that the company is generating a substantial amount of positive operating cash flow. This trend suggests that the company's operations are profitable and well managed, allowing it to generate sufficient cash to cover its expenses while also having a surplus for future investments or debt repayment. Overall, the data indicates that the company is in a strong financial position, with a significant positive operating cash flow. The company's recent performance has been notable in several key segments. In China, the segment has shown a strong performance, particularly with the regulatory approval of VLSIPITY. This development is expected to contribute positively to the region's growth. On a global scale, promising growth drivers have emerged, including the EVE-RONE and mRNA programs. These initiatives are likely to propel the company forward in terms of expansion and revenue generation. Overall, these developments indicate a positive trajectory for the company across various regions. Management is projecting significant revenue growth driven by the success of NEFECON in China and expansion into new markets. The company will continue to advance its pipeline across multiple therapeutic areas, including autoimmune diseases, cardiovascular disease, and ophthalmology. Key growth drivers in 2026 are expected to be NEFECON, XCRAVA, and VLSIPITY. Management is optimistic about the company's outlook due to strong product, revenue growth, and improved operational efficiency. The focus will remain on commercial execution, deepening core franchises, and expanding market reach. In addition, the company plans to accelerate development of its innovative pipeline and proprietary egg-enabled mRNA platform. The long-term goal is to exceed RMB 15 billion in annual revenue by 2030 through a disciplined business development strategy aligned with the 2030 roadmap. The company also expects to report IIT Phase 1A data for EV-M16 and initiate an IIT Phase 1 billion trial in 2026, further advancing its pipeline. The company has a history of paying out dividends to its shareholders. This is evident from the clear indication on pages 136 and 189, where it is stated that the company has indeed paid dividends. However, there is no mention or evidence of share buybacks in the provided information. It appears that the company's focus has been on distributing profits to its investors through dividend payments rather than repurchasing shares. Concerns about inventory buildup and supply chain disruption. There are valid concerns regarding the buildup of inventory in certain areas of production. A significant increase in raw materials has been observed, with numbers rising from 0 to 15,787 on page 180. This substantial jump indicates a potential issue with inventory buildup, which can have far-reaching consequences for supply chains and overall operations. That concludes the financial summary for Everest Medicines Limited. Feel free to comment below, and I will be happy to answer them when possible.